Welcome to all of our audience and participants today. I'm very excited about this webinar. We've got a really great lineup of panelists and a super interesting topic to discuss. So I'm going to start off by asking our panelists if you can please switch your cameras on so that we can see all of you. Thank you. And we'll have a quick round of introductions before we get into the discussion. So as Helen mentioned, I'm Jannah Patchay. I'm one of the originating team members of the Digital Pound Foundation, as well as currently an executive director of the DPF and its policy lead as well. So I lead on our policy engagement work and our kind of legal and regulatory explorations and a lot of our strategy and thought leadership as well. And I'm going to go around the screen as I can see it and ask for very brief introductions. Laura.
Thanks, Jannah. Yes, hello everyone. I'm Laura Douglas. I am a senior regulatory and fintech lawyer in the financial regulation team at Clifford. So I advise clients on a range of digital assets, fintech, regulatory matters.
Thank you. Shreyosee.
Hi, Jannah, and good afternoon, everyone. My name is Shreyosee Dutta-Roy, and I'm a product owner in Group Treasury Digital Assets team in UBS, where I design and implement DLT products in debt issuance and repo space. I also have a broader focus on digital payments and CBDCs, where I drive some of the flagship initiatives for the banks. So looking forward to discussion today. Thank you. Thank you.
Duncan.
Hi there. My name's Duncan. I'm Managing Director and Global Co-Head of Digital Assets at TP ICAP.
And last but not least, Lee.
Hi, everybody. Lee Schneider. I am the General Counsel at Avalabs. We work on the Avalanche public blockchain. I run around and do way too many other things to list, but all of them are related to blockchain, crypto assets, and Web3 in one way or another.
Thanks, Lee. And we should also mention that our original Avalabs speaker, Lydia Chu, isn't able to make it today, so Lee is standing in for her. However, he's eminently qualified to stand in for her, being also an originating team member behind the DPF as well. So to get started, I think, when we talk about digital settlement assets and their role in transforming financial markets, I think it's important to set the scene as to what we mean in terms of the scope of the digital assets that we're talking about. And I know some of you have slightly different views of that coming from your different backgrounds. And that's part of what makes this interesting. Laura, coming from a service provider perspective where many of your clients are working in this space. Shreyosee, in terms of some of the projects that you've been involved in as a bank. Lee, in terms of building the ecosystem that supports this transition to digital financial markets. And Duncan, as someone who's trying to work out what the future of financial markets looks like and how to support it. So I think I'm going to start off by asking Duncan, as you know, probably the person most hands-on in terms of building out infrastructure to support the future of financial markets, trading, etc. What, in your view, is the scope of the digital assets that we're talking about? Does it include cryptocurrencies? Does it include tokenized bonds and other securities? Oh, Duncan has just left. Let's see if he rejoins in a second. In that case, I might go put Lee on the spot since he's a late joiner in any case. Lee, if we assume that, you know, when we talk about digital asset markets and the transformation of financial markets, we're talking not only about crypto markets, which can be seen as a kind of testbed and stepping stones to those, but also to tokenization, so tokenized asset markets. Can you explain a little bit about tokenization and the benefits that it brings?
Sure, and I'll start by saying, look, at Avalabs and at Avalanche, our goal is to digitize all of the world's assets, and most of that digitization we think will happen on blockchain. So we see what people loosely refer to as cryptocurrencies as sort of, to your point, Jannah, the first step in the evolution. But we expect, frankly, that all different types of assets will be quote unquote tokenized, by which we mean digital representations of those assets on blockchain will become a real thing. So not just digitization on blockchain or tokenization on blockchain of, for example, stocks and bonds, but also other types of financial instruments. But even beyond that, to what I refer to as physical asset tokens, services tokens, and intangible asset tokens. Because tokenization is just the creation of a digital representation, it's just like writing something on a piece of paper. It's just a digital piece of paper that you write on. And so really that could be anything.
Thanks, Lee, and Duncan, nice to see that you managed to get back in. Coming back to you then. So this tokenized world of the future is a very interesting one, and we'll go a little bit more into that as the panel progresses, but it doesn't yet exist. And as you are someone who's been tasked with building out the infrastructure to support a world in which it exists, how do you start with that, and what's your stepping stone towards developing that infrastructure?
Good question. And look, we're a Teams organization over here, so sometimes we have a little trouble with Zoom, so apologies about dropping off there for a second. For us as an organization, when we fundamentally believe that blockchain and DLT as a technology innovation will have a lot of potential for the function of wholesale financial markets, in terms of getting to the heart of transfer of value and automation of settlement and speed of settlement. And when we started as an organization thinking about what the impact would be for us as a financial marketplace and a venue operator, we came to the decision that we needed to experiment and build and learn by doing, and that back in 2018, when we first started on this journey, crypto was the place to do that for us, because it was a liquid asset class on this technology, and we had client demand for these type of products, and that's given us an area to experiment and learn what's different about transfer and settlement of value when it exists as a token rather than in our traditional sort of systems that we have across financial services. It's an area that has had lots of conflicting misinformation, and it has a checkered history, but there has been demand from our clients, and that's where we started.
And how do you take that to the next level? How does that strategy evolve over time to support the development of digital asset markets?
Well, I think to Lee's point earlier, the core concept here is the role of a token, whether that's on a open source public infrastructure like blockchain, or whether that's on a distributed ledger of some form that may be permissioned and run by a consortia of different participants. But the service providers that can support those are largely the same, irrespective. It's understanding how to do digital custody and hold a wallet. And of course, there's technical lift depending on which chain you support. But digital custody is a service that can be applied in general to both. And then as a markets operator and a venue operator, you start thinking through, well, if we want to settle more quickly or with precision or on the same day that we trade, what do we need to do that? And typically that's things such as, well, you need to ensure that the asset is available to settle, which typically isn't how financial markets operate, right? we have a whole network of trading, and then that feeds into middle and back office, and there are whole teams of operations going, right, how do we find the collateral to actually make good on this settlement? And there's a whole system of borrowing, lending, sourcing, whether it be stocks or bonds or such like, in order to fulfill the payments required that have been led to by the front office. I think one of the things we quickly learned was, if you're going to settle in, well, real-time precision or on the same day, you need to think very differently about collateral availability. So now that we've built that capability, we look at things like you need a confluence of factors. You need the right issuances in traditional asset classes. You need investor demand, so it has to be a materially better experience for the investor to switch to this infrastructure. And then you also need the appropriate regulatory framework so that firms like ourselves can operate within an environment where we're subject to appropriate regulation. But certainly in Europe and UK, we have things like the EU DLT pilot regime and the digital sandbox, which is upcoming in the UK.
Thanks, Duncan. And following on from that, Shreyosee, you're from a very traditional financial institution, a well-known bank, albeit one that has been very active in its explorations in this space for several years now. What do you see as the drivers for more institutional digital asset adoption, particularly by traditional financial services players?
Sure. I like to maybe add to what Duncan said, right? Regulatory clarity is definitely a very, it is a key driver. So we know that, some jurisdictions are, of course, much better or much advanced in that area than others. Coming from a Swiss bank, I think the Swiss DLT law is definitely quite advanced, and we do benefit a lot from that. Now, apart from the regulatory clarity, I think there's another point that is the speed of product delivery and the time to market. I think that's also a very big factor for digital asset adoption. So now, how do we get there? So I think coming from a practitioner's perspective, I think it's important to first of all understand the business value of the product quite upfront. i.e., what does it mean for the bank and what does it mean for end clients? Is it going to enhance client experience, or do we want to reduce our operational cost, or is the product going to create a new or additional revenue stream? So I think once we are quite clear on that, we should quickly move towards a phased delivery approach. I've seen this a shift in mindset since we've been in this space for quite some time. You see the mindset is really shifting from innovation to transformation. So from POCs and experiments to live products, creating tangible value for end clients. And I feel that the quicker we get there and show the real value of these digital asset products, right, the better and more we contribute towards adoption.
Just picking up on some points there, you really put an emphasis on the real benefits, real value. What are the benefits of tokenization over the way things are done at the moment and things like that? And what are some of the benefits that you see and that financial institutions see tokenization as bringing, and the digitization of assets as bringing to the financial services sector?
I think one key aspect would be the aspect of transparency, right? And another key aspect would be the settlement aspect. Now, Duncan mentioned same-day settlement or atomic settlement, for example. I think for us, what is more important is to understand or have a guarantee of settlement. So, for example, whether it's T+2 or it's T+1 or T0 doesn't matter, as long as we have a guarantee that it is going to settle a payment or an obligation is going to settle at a precise amount of time. What happens is it helps us to kind of maybe park park less liquidity or have less buffers, right? So from a planning perspective, from the liquidity perspective, I think that's definitely one benefit that we see. Another aspect is obviously in general tokenization. With tokenization, we feel that the aspect of programmability, right? That you can program things on smart contracts, it is beneficial. So for example, if you have corporate actions or life cycle events, right? If you can program things on or make it more rule based, I think that has benefits also to kind of cut down on some intermediaries, I would say. But yeah, that's about it.
And coming back to you, Lee, Shreyosee has described a lot of the benefits from a financial markets participant perspective. I know you have a much broader sort of tokenize the world view of things. What broader benefits do you see tokenization bringing in terms of real world assets and non-fungible tokens and things like that? And also adding to that, I guess, a more philosophical question is as to whether we do actually want to financialize, the world and attribute financial value to all these things that, may not necessarily have the same, motivating factors behind the way they're bought and sold and traded at the moment.
I think that last question, Jannah, is probably deserves its own full session. Because I think it's a very interesting question, and it's a difficult one to grapple with. I used to have vociferous arguments with a very good friend of mine in college about whether economics was a moral choice or morality was an economic choice. And I think that's effectively the question that you're asking me. So maybe we need a beer to settle that one. But going back to the sort of more concrete question of what are the advantages of tokenization, I think there are three primary advantages. The first of those advantages is that it moves the digital representations of things onto the open internet. It allows for the movement of those things onto the open internet. And that means that it gives each of those assets, regardless of what it is, a global reach and global tradability. So when we look at marketplaces, rather than saying, well, stocks trade over there and bonds trade this way and wheat trades in some other venue, we now bring all of these things together into a large global marketplace that also does not require fiat intermediation between transactions. So you'll be able to swap directly rather than having to intermediate with fiat currency. The second big advantage that I see is, I guess, relatedly, that this infrastructure is a much more efficient infrastructure to allow people to interact. And by the way, financial markets infrastructure has been moving in this direction for the last 50 years. Right, we look back 50 or more years ago, we were very much a paper-based T+7 settlement cycle for securities or T+10 even. And we continue to move more and more to the digital. We continue to move more and more to the faster. We continue to move more and more to straight through execution and processing. And so I don't think we're trying to really revolutionize the directional forces here. It's just that we've got this technology that's allowing us to revolutionize the way that these interactions are happening. And then the last thing I would say is, again, with open, public, permissionless blockchains, but also with the software developer kits and programmability, the ability for anybody to do these things, to launch these things, we're going to open this up to a lot more players in all of these different spaces. And I think that's going to bring the global marketplace closer together for a lot of reasons.
Thanks, Lee. And I think we've now heard from the first three participants a lot on the benefits of tokenization, what it can bring in terms of programmability, transparency, potentially greater liquidity and things like that. But Laura, coming to you as the lawyer who has worked on many of these projects and many of your clients are exploring this space, obviously the blockers are not of a technological nature. The technology exists to achieve all this. It's often the legal and regulatory frameworks that are holding back progress or holding back initiatives from moving forwards and wider adoption. So can you tell us a bit more about your experience in that space?
Sure. And I think, you know, this is obviously an area where the technology has progressed very quickly and in ways that the existing legal regulatory frameworks hadn't necessarily anticipated. So I think, you know, looking at this from the perspective of a regulatory lawyer, I think, you know, we are seeing the legal and regulatory frameworks starting to catch up, and you know, a lot of progress has been made in certain areas, in certain jurisdictions. I think as a big picture comment as well, actually the inherently global or cross-border nature of a lot of this activity, to go back to Lee's point, sort of, you know, opening this up with global reach rather than markets necessarily being, you know, an exchange in one particular jurisdiction, also raises a lot of tricky legal questions as to even which is the right law or regulation to apply. And so sort of in that context, I think what we've seen in practice clients doing is, you know, particularly those, I mean, you know, we've kind of worked with both the sort of the, you know, the crypto sort of world, but also, you know, more traditional financial institutions looking at the benefits of DLT and the technology for tokenizing, for example, traditional securities or you know, digital settlement assets as you know, an alternative to cash or other forms of money. And I think what's common to all of those is that, you know, actually a lot of structuring decisions or decisions on when to do what and in which jurisdictions are dependent on how far has the legal and regulatory framework moved in that jurisdiction to give people sufficient certainty as to what the position is. And maybe to give you, you know, examples, you know, a lot of the conversations that we're having at the moment, say around the UK, is very much that, you know, our framework for regulation of crypto assets is coming. We've got the Financial Services and Markets Act 2023 there to lay the groundwork for that. Similarly for, you know, a broader regulatory framework for digital settlement assets, we've got the sandbox coming, but we don't have the full shape of that yet. And so actually in the UK, what people are looking at is projects that or structuring things in a way that they do fall within existing well-defined sort of regulatory concepts. So say tokenization of securities, or, you know, fitting within an e-money kind of characterization, or alternatively looking at ways of using, you know, distributed ledger technology in a way that is more a sort of a pure record keeping rather than creating a, you know, a new asset as such. And so, you know, there's a lot of analysis done around this, but I think from a sort of, you know, a barriers to mass adoption perspective, actually you kind of have to do that analysis in every jurisdiction that you're looking at. Jurisdictions are at different stages of development, and so I think it you know, things are in flux. I think, you know, we're moving in the right direction, broadly speaking, in terms of getting that regulatory certainty. But there's, you know, there's still a way to go. And I think it is an important factor in the way that the projects that we've seen, whether that's, you know, EIB digital bonds, you know, how are they designed? And often, you know, looking at the questions of secondary market liquidity, for example, again, that's where I think some of the sandboxes are coming in to say, well, are there barriers to using this technology in traditional financial markets that a sandbox or a pilot regime can solve? But we're still at the beginning of that process today.
Thanks. And you aren't the only lawyer on the call. We do have another one in the form of Lee, although sometimes even I forget that Lee is actually a lawyer. I guess, Lee, you're coming at it from the other side of the fence, really, as, you know, someone who would be on the client side of Clifford Chance, really. And in terms of what Laura's described in terms of, you know, regulatory challenges, cross-border challenges, operating in multiple jurisdictions, and the challenges of understanding applicable requirements and all of them, what's some of your practical experience of those challenges that are blocking the work that you're doing in terms of growing digital asset markets at the moment?
Yeah, so we find it's best just to ignore regulation altogether. It just makes life so much easier. No, seriously. Look, there are a lot of challenges, and I think Laura made the excellent point at the beginning of her remarks that the technology has advanced much quicker than the regulation has, and in ways that the regulation has not really anticipated. And that was a bit of a follow-on to the point that I had made earlier about how the evolution of technology has moved us towards straight-through execution and processing. But neither market participants nor regulators were prepared for the size and scope of the change that blockchain and tokenization has brought. So look, the approach that we adopt is obviously we try to comply with regulations to the extent that we understand them and that they exist. Sometimes we see regulations that are not particularly workable, and so we try to engage with regulators in those instances. We do spend a lot of time with our outside counsel, including some of Laura's colleagues at Clifford Chance, as well as plenty of other law firms. I think, you know, the biggest challenge is that some of the things that are happening are really unprecedented, either in financial services law and regulation or in consumer protection law and regulation. And then just to throw a further element of confusion there, in the sort of anti-money laundering realm of regulation as well. And so trying to sort of untangle the bowl of spaghetti that results when we bring all of those things together for some of the products and services that we offer really does lead us to try to scope what we're doing so that it's subject to the least amount of regulation possible, not because we're scared of regulation, but more because the more regulation that applies, the more complicated and confusing it gets for everybody. So we have the luxury as a technology company, as a software company, to sort of be focused in particular ways. If we were trying to be an exchange or trading venue, if we were trying to engage in some of the more traditional financial services type activities or trading venue type activities, we would have a much bigger task in front of us.
Thanks, Lee. And I've had a message from Helen saying a few people have asked if there'll be a recording afterwards if someone was struggling with sound. There will be a recording available afterwards on our YouTube channel, and we'll also be circulating a write-up of key takeaways for anyone who is curious about that. So we're halfway through at the moment, and I think we've done a really good job of setting the scene in terms of what tokenization is, what digital asset markets are, and how they can contribute to the future development of financial markets. And now getting onto the part that's particularly dear to the heart of the Digital Pound Foundation, the role of settlement and wholesale digital settlement assets in particular in overcoming some of the barriers to mass adoption of digital assets. So exploring this topic further, Duncan, could you tell us a little bit more about, the problem statement around settlement? What's the current state of settlement in terms of digital asset trading and transactions? And what are some of the barriers in terms of the settlement assets that are available at the moment?
Good question. So I think a key term here is the use of the word settlement asset, and I think one of the points that Lee made earlier is how we have across traditional finance lots of different systems, usually asset class per asset class, sometimes different when it's the spot asset compared to derivative markets, but typically we have various different systems that have been put in place to settle the world's financial, energy and commodities products that get transacted across our economy. One key thing is that they're on different systems, so there's no fungibility between them in general. And two, most of these systems were designed within a set of constraints that were limited by the power of that technology at the time. What is interesting about blockchain and DLT is it's reshaped the parameters of how you can design a settlement system, because you're no longer constrained to slower settlement times. Although to Shreyosee's point earlier, you don't necessarily always want to settle immediately or atomically, because you can build up additional costs in trading and settling every transaction, and you lose some of the efficiencies of netting. There's been a couple of good questions actually. One from Alistair around how do we handle the additional liquidity costs of same-day settlement, and does that mean pre-funding, and what does that do to clearing in general? And another from an anonymous attendee saying, are we assuming that DLT atomic settlement gains are higher than the costs associated with capital management of liquidity? I think brilliant questions, and I think to set out the problem statement here, there is a large cost that financial markets firms, banks, the exchanges, the custodians, and ultimately end investors bear in terms of settlement, and that largely comes from credit risk management. So managing the fact that, you know, if you are in a trade or with someone else, and what is the risk of them going bust and you not getting what you agreed to, whether that's on a spot asset that you maybe want to settle within 2 days, or whether that's on a derivatives contract that's open for months. And what we have in financial markets is these systems that have been designed pre the ability to use blockchain and DLT. So, I mean, to answer some of these questions, we don't really know what that system should look like now. And if you look across the crypto ecosystem, you look across banks that are implementing tokenization, what's really exciting about this space is people are innovating, they're experimenting, they're saying, you know, what should clearing look like in a world with the possibility to settle within 10 minutes or 20 blocks on Ethereum. And, you know, off the back of that, because some of these things don't go away, you still want to manage credit risk. You still got these risk management processes in a way. You want to ensure that you get the delivery and you get guaranteed delivery. But now we have a new design space. And I think the role of stablecoins, CBDCs, and digital settlement assets, currently, we generally want to settle these contracts or these spot assets against some form of money. Having a stable coin or a CBDC means that high quality fiat money, whether it's central bank issued or whether it's commercially issued or whether it's through a private corporation, is available on the same technology and can therefore be exchanged at the same pace. That's a real essential component to being able to transact on this system. But as to the questions there, what does that settlement infrastructure look like? We don't know at this stage, and that's what people are innovating on at the moment.
Thanks, Duncan. And just for the benefit of some viewers as well, and I guess as a segue into asking Shreyosee about some of her more practical work, obviously, if we have, you know, these great tokenized assets, digital assets that have the potential to be traded and settled in real time, then we have to think about the other leg of the transaction, obviously, the payment or settlements leg. And we need something that is also on the same technology infrastructure, so on ledger or on blockchain, for that settlement to happen. Now, obviously, without getting into the whole, you know, is Bitcoin a valid means of exchange argument. Bitcoin and other cryptocurrencies are generally deemed to be too volatile to be used as those settlement assets. Privately issued stablecoins, which are fiat referenced, tend to be the default at the moment. But for financial institutions like TP ICAP and its clients, or like UBS and other banks that want to experiment in this space, the counterparty credit risk that's introduced by the issuer of a stablecoin and the uncertainty around the regulatory frameworks around stablecoins pose a huge challenge to that. And so the search, the quest is on for basically the counterparty or / issuer risk-free settlement asset. And Shreyosee, you've been involved in some of the work that UBS has been doing with the Swiss National Bank on some of Project Helvetia, working with other private sector projects and initiatives as well, such as Panellists, which UBS was an early supporter of. Can you tell us a little bit about what you're trying to achieve with those as an institution, and what some of the successes and challenges have been there as well?
Sure, Jannah. So overall, I think the aspect of programmable money and these new forms of digital payments, they're definitely key enablers in the digital asset market, hence solving some of the settlement barriers that Duncan just mentioned. So keeping it simple, if you have an asset on chain, you really need to have a robust digital payment mechanism to settle as well, right? And a digital payment mechanism which also complies with today's regulation and policy framework. Now, in UBS, we quite extensively work on such forms of payment, like I said, but keeping in mind what the reg allows us to do today. So citing some examples, we do work and we partner quite closely with central banks on the topic of CBDC. Being a Swiss bank, we are quite fortunate that SNB is quite hands-on this topic. So we have worked quite closely with SNB for wholesale CBDC projects such as Helvetia Phase 2, as well as Project Jannah. So where we really explored the settlement of these digital assets with central bank money in both a domestic setup as well as a cross-border setup. Now, in terms of benefits of wholesale CBDC, we do see some benefits in scaling the secondary market activities, which is quite fragmented today due to the lack of a robust cash solution. Now, in terms of, we are watching the space of retail CBDC. We are not, but we are not actively engaged in retail CBDC as of yet. Now, of course, there are benefits in cross-border with wholesale CBDC, but to Laura's point, it is not as simple because there are regulatory barriers. In a domestic setup, there are far more regulatory barriers in a cross-border setup, right? But of course, there are, I think Project Jannah explored the same thing, right? Where, they did a DVP with central bank digital currency. So I think we are experimenting and watching this space. Like with SNB, we are a bit more hands-on, on this topic. Now, you also touched upon finality, which is more like intermediated CBDC or synthetic CBDC. It's for those who don't know, finality is a consortium of FMIs created for creating a tokenized settlement asset, which aims to reduce counterparty risk. So it is basically you can generate tokens out of a central bank omnibus account, which is going to help you with wholesale payments or peer-to-peer payments, right? So that's definitely something to watch out for. You also touched upon stable coins, and I completely agree. I think the use case for when it comes to stable coins, the use case for commercial banks is still limited. Also, given the regulatory uncertainty around stable coins. So I will pause there.
Thanks, Shreyosee. And I wanted to pick up with Laura on the point about stablecoins and uncertainty around stablecoins. Do you think that these sorts of barriers to institutional use of stablecoins as a settlement asset can be overcome? And do you think that would, in the UK and further afield as well, regulatory initiatives are taking the right steps to address those barriers? Yeah.
So I think, yes, the barriers can be overcome. I think, and that's probably evidenced actually by some of the projects we've just been talking about, that have found a way to navigate the legal and regulatory landscape as it stands today. I mean, I think, perhaps some of those barriers, sort of encourage projects to go down certain routes in terms of how they have designed the systems to work, to sort of avoid the areas where there's maybe the most kind of regulatory uncertainty about how things might be characterized, or where there are, changes that haven't kind of materialized in regulatory frameworks. But then I think, particularly in the UK, obviously we're expecting sort of additional consultations to come out hopefully relatively soon on sort of a digital settlement assets framework. And of course, Treasury has already consulted on sort of financial stability type considerations around systemic importance and systemically important digital asset settlement systems. So I think, and maybe in terms of, what's the way forward, really thinking of, on the digital settlement asset side, I mean, we already have a range of types of money or payment instruments, ranging from kind of central bank, money. So, reserve accounts that only large financial institutions tend to have access to commercial bank money, to sort of, probably more on the retail side, e-money. And, each of those has a slightly different regulatory regime, and that is reflective of, the different characteristics of those different sort of, settlement mechanisms. And so I think it's not necessarily a one size fits all if you put a sort of a DLT overlay to those different kinds of, money that we have circulating today, or ways of settling. So, to go to the sort of the wholesale point and maybe sort of, the finality type structure, I think it's right that the focus there is on, financial stability and what does it look like when a system becomes systemic, as opposed to something that is more like a privately issued stable coin. And there very much the focus is on, thinking about some of the things around the e-money regime today. If that asset represents a claim on the issuer, then effectively you're taking credit risk on the issuer. There's no deposit guarantee for e-money today, and so again, that's sort of an important consideration for any regulatory regime, that actually this isn't one size fits all, that there are those nuances, and sort of we talk about stable coins, but again, that's probably a term that encompasses quite a lot of different potential structures from a regulatory perspective. So I think, as I say, regulatory responses to that, again, probably need to be nuanced to look at sort of the use cases that the technology is working within. And I think, we do see that happening, but I think it is one to, to keep an eye on as well.
Sorry, my screen froze up a bit there. So it sounds as though if we are to see potentially systemically important stablecoins become used as digital settlement assets, then the issuers may need to start looking a lot more like traditional issuers of different types of money, basically. So before I get onto some of the Q&A, I wanted to give you all a question that does tie in with one of the Q&A questions, actually. So we had someone ask, what are some of the unique use cases that can be used for digital settlement assets? And I think in our prep session, we discussed what are the other potential innovative applications for digital settlement assets. And you all had some interesting and varied thoughts around that. So we'll start off with Shreyosee. You had some thoughts around using digital settlement assets as opportunities for improving liquidity, for example.
Yeah, right, Jannah. I think overall the advancement in the digital settlement asset being used as a payment obligation, it will help in building a liquid secondary market. So if I take the example of digital bonds today, right, we do have a slower secondary market because of fragmented liquidity, and mostly because we lack coherent payment solution. Now, to your point, commercial tokens, stablecoins do the job, but they have counterparty risk, they have third-party risk. In our bank today, we cannot hold them overnight. So basically what that means is we have to constantly tokenize, detokenize, pre-fund the wallet and pre-position, digital cash to, for any buy and sell activity. Now, the outcome of this is that it slows down trading opportunities. So whilst I think if we can actually attract more participants in this secondary market, if we have a better payment solution, if we have a better cash solution, that also fits in with the risk appetite of regulated FMIs like the banks.
I think, Laura, you also had some thoughts on innovative applications in the payments and cash management and liquidity management space.
Yeah, so maybe along similar lines to what Shreyosee you've been saying, but if you think about sort of digital settlement assets as a sort of a kind of used in payments, and how our payments and what sort of needs are there, particularly say around sort of treasury liquidity management in payments, I think you can potentially see some use cases, advantages to having a technology and system where you can use smart contracts, and thinking about sort of liquidity management, kind of zero balancing and all of those kinds of products that are out there today to help corporate groups and others kind of manage where are their funds sitting, how are they working most efficiently. Again, I think you can see advantages potentially for the technology to just make that more efficient, more automated, rather than potentially relying on Swift messages going one way saying how much is in this account coming back, and that's quite a manual process that you could foresee becoming much more automated and efficient, not necessarily just because of sort of digital ledger technology, but also the ability to have sort of programmable smart contracts involved in the system too.
Thanks, Laura. And going to Lee and Duncan, I know with both of you in our prep sessions, where we, when we posed this question, you both had the view of, well, if we really go down the rabbit hole, or, have our matrix moment in the future, and you've alluded to this already on the discussion, Lee, then do we even need digital settlement assets in the future where there is potential for all-to-all asset markets? And it would be interesting to hear more of both of your thoughts on that. For me personally, one of the interesting questions is, do you not still need some form of reference pricing? How in practice do these all-to-all markets of the future work? But I'll turn to Duncan first and see you've already said a few words on it.
I think that we're at risk of increasing fragmentation in digital settlement assets, because we're in the phase of innovation at the moment where there are so many different technology stacks in existence. So I think you've got the Bitcoin network, the Ethereum network, you've got a whole host of L1 networks that have evolved from crypto, you've got a whole host of bank operated DLT platforms, consortias like have been mentioned on this panel previously, and there's a whole host of technology companies that are trying to build adoption across the industry of their particular DLT solution. The utopia, as you refer, as you talk about, Jannah, is imagine if everybody was on one ledger. And that's really important because, yes, you can have a digital settlement asset on a common ledger, but if the asset you're trading against is on a different ledger, you're always going to have to manage that delivery versus payment process, because and how useful can a smart contract be if one leg of the transaction is on a different system to the other leg, which is on the settlement system. So one of the things that we encourage here at TP ICAP, and I think the industry needs to look at, is the adoption and the distribution of, and maybe some consolidation around the systems we use, because otherwise all of these benefits we've been talking about today will be difficult to actually implement. But to your point, and the reason why I explain that is because if you want to do asset to asset direct trading, so the problem case here is, why should an investor sell out of their bond holdings or get, say, US dollars back for that, and then take those US dollars to a different system in order to enter into a trade where they hold commodity futures, for example, and you've essentially got multiple legs in terms of switching from your bond instrument into your commodity futures instrument. Or if both were tokens and, crucially, on the same system, so the same DLT or blockchain system, could you just trade, sell out of your bond and buy into a commodities futures token position? And on what Jannah's talking about here is, well, how do you price that? Because if you don't price the first leg versus dollars and the second leg versus dollars, how do you manage that reference pricing between the two? I don't have a good answer for you, Jannah. I would say there are a plethora of high frequency trading firms and market makers out there that are sort of dealing with this problem at the moment in the crypto industry, when you're offering pricing between two crypto tokens directly, and then quoting that on screen. I mean, you can look at Uniswap as an example. Your actual settlement will go between say one ETH token and another ETH token, but the order book on Uniswap is quoted in say US dollars or whatever currency you want. So I would look to places like that where you can see people dealing with that problem in real time. But the exciting thing here is, could we potentially reduce the cost of a transaction by reducing the legs in the transaction and going directly from one asset to another?
That's really interesting, Duncan. And Lee, what do you have anything to add to Duncan's thoughts on that? How this is a topic that's very close to your heart as well, and how do you see it working in practice in the future?
Just to relate from personal experience, when I was playing around with DeFi and a couple summers ago, I tried to create my own liquidity pools with matching two assets that were not already a liquidity pool on Uniswap, and getting uptake for trading in a pair that you create that's not already on Uniswap, at least at that time, was impossible. I created, I think, 3 or 4 different pairs over the course of a week, and none of the pairs ever traded. And so to Duncan's point, everybody's looking at that dollar reference. Will that change in the future? I'm not 100% sure. I think also to Duncan's point, the key is, even if the pricing doesn't change, will we be able to just swap the assets as a way of settling rather than having to intermediate through a fiat currency? You know, the other thing that I think we haven't talked so much about here is what is the usefulness of stablecoins and CBDCs outside of the context of on-chain and the purely digital world. And I think, you know, that to me is sort of the next really interesting set of possibilities. We already employ independent contractors. They prefer to get paid in USDC or AVAX as opposed to US dollars or their local currency. And, you know, to what extent am I going to, within the next 5 years, be able to go buy a slice of pizza and pay for it in USDC, or in London get a curry and pay for it in digital pounds, right? That to me is the other interesting part of the equation.
Thanks, Lee. And I was hoping to get final views on the ecosystem of the future, but I think we probably won't have time given we've got approximately 2 minutes left. So I would like to very much thank all our panelists today. I think we've had a really broad range of different views, which is what we intended. People with different perspectives from different parts of the industry and the wider ecosystem. And that's exactly what we're trying to do at the Digital Pound Foundation, is to broaden out the conversation on these topics around settlements, payments, and the future of money, and this kind of digital markets infrastructure of the future to encompass as broad a range of participants as possible. To Lee's point about what are the other uses for these new forms of digital money, that's 95% of our work with the Digital Pound Foundation so far. So if anyone would like to find out more, we've got some very active working groups putting out some super interesting papers and things like that. So have a look at our website if you'd like to become more engaged with us. We have a great use case working group who are exploring real life use cases for these sorts of things as well. Thank you very much to all of the audience who joined in today. And thank you very much to our panelists as well for your insights.